Main myth is that leverage ETFs suffer from volatility decay and eventually go to zero. Now, this isn't true and is easily disproved by looking at historical data. Volatility decay does exist, but don't be misled. I've spoken about this subject before, and I find that ETFs work pretty much exactly as advertised. That's not to say they don't suffer soul-crushing drawdowns, but once you see that the 3 times leverage S&P 500 ETF UPRO is up over 5,204% since the low in July 2009 versus the paltry 480% for the S&P 500, it's hard to ignore the potential. To give you some perspective, the UPRO return is nearly 11 times the return of the SPY ETF. Now that's a massive return versus what the media might have you believe when investing in leverage ETFs. However, the volatility of owning leverage ETFs is real. UPRO went down around 40% in 2018, over 50% in 2011, and a heart-stopping drop of 78% in 2020. That is just a taste of the volatility one can experience investing in leverage ETFs. UPRO didn't exist in 2008, but the ProShares Ultra S&P 500 SSO, a 2 times leverage ETF, did and went down 80% in the bear market, only to recover by 2013. However, despite the risks, the leverage investing strategy has supporters in an unlikely place, the economics department of Yale. In 2010, 2 Yale professors wrote a book called Lifecycle Investing. The book was fairly well read among economists, but less so among the general public. The key ideas from the book were as follows. Investors tend to not save much money early in their careers. As such, their ability to retire hinges on the performance of equity markets in the 15 years preceding their retirement when they start to aggressively save. This leads to a concentration risk. One of the co-authors had this to say: "We believe in stocks for the long run, but most people, when they have lots of stocks, don't have the long run, and when they have the long run, don't have lots of stocks. People seriously underinvest in the market for the first 25 years of their working life. The prescription," they argued, "is to use leverage early in your career with leverage ETFs, margin, or options, and as you get closer to retirement, gradually reduce your leverage to a standard 60-40 portfolio." I personally disagree a bit with the 60-40 portfolio allocation, but it's been a standard go-to investment strategy for years, endorsed by many professionals. The idea is that you can keep the amount of risk you take over time constant in dollar terms. They found that following such a strategy actually reduces lifetime risk, as defined by the standard deviation of savings at retirement, by more than 20% compared to the conventional method. This result held up both in historical simulations and in Monte Carlo simulations. The key to implementing the strategy is to follow the plan, which is understandably difficult for many people. However, given the poor performance of stock picking and actively managed mutual funds for most investors, this strategy may actually paradoxically be easier to follow because investors realize it works when they see the results over time. So let's go over some approaches to leverage portfolios. There are techniques that are helpful for normal portfolios that can also be helpful for leverage portfolios as well. One technique that really helps leverage portfolios is called rebalancing. One low-risk approach to portfolio construction using leverage is to put 33% of the portfolio in UPRO and 67% in bonds, and then rebalance periodically. This gets you a gross exposure of 167% of your net asset value and will have less volatility than stocks when bonds and stocks are negatively correlated. I tested this using 33% UPRO and 67% IEF, which is the intermediate treasuries. The leverage portfolio is in blue. As you can see, the portfolio beats the market by a couple percentage points per year with less risk. This approach isn't better or worse than the professor's higher octane approach, but rather illustrates that rebalancing and combining leverage ETFs with other asset classes produce favorable outcomes and better risk-adjusted returns. Another approach that pairs well with leverage ETFs is called dollar cost averaging. If you're going to be adding money over time, as someone who is early in their life cycle is, then large drawdowns represent an opportunity to add money and buy low. Probably the simplest way to implement this approach for a young investor comfortable with a lot of risk is to put 70% of your money in UPRO and 30% in the 30-year Treasury bond ETF TLT and rebalance either monthly or quarterly. Then simply add money over time, rebalance quarterly, and your portfolio will typically grow quite quickly. Here's how that portfolio would have done since 2010. That's assuming a $10,000 initial investment and $1,000 per quarter added to the portfolio. You'd be sitting on a $430,000 portfolio after 10 years. The key to reducing path dependence is to add money over time. Another approach used by professionals of leverage is targeting volatility. When this is done systematically with the use of leverage, I like to call it volatility arbitrage, which is the extraction of extra trading profits from using more leverage during times when markets are calm and less leverage when they are volatile. Here's an example of a portfolio that adjusts the amount of UPRO and Treasury bonds monthly to target 15% annualized volatility. Buy and hold leverage is in red, volatility targeting is in blue, and the S&P 500 is in yellow. Now, if you look, you can see that the volatility targeted portfolio cuts far more risk than return away from the buy and hold leverage portfolio. People in real life are successfully implementing these strategies. My strategies take investing to a whole nother level on all metrics like risk-adjusted returns, drawdown, correlation to the S&P 500, that when combined provides a total portfolio solution. Here is what my core strategy has achieved since 1997, which includes the dot-com bust, the Great Recession, and the pandemic of 2020. You'll notice my core strategy didn't blink an eye during those times. It mostly avoided those tough times and actually made a profit. Now, this wouldn't be possible without my years of knowledge about market volatility and how to use it to my advantage. I generally agree with the Yale lifecycle theory, but each investor will have a specific risk tolerance and personality that will determine the proper amount of risk to take. Some people in their 20s and 30s are comfortable with the risk that you get with leverage ETFs, but such strategies are far less likely to be attractive for someone over 55. Personality plays a role too. Leverage introduces path dependence to the equation. If another crash on the level of 1987 occurs, 3 times leverage ETFs will see one-day drawdowns in excess of 60%. Granted, they will come back quickly on the way up, but you mentally have to be prepared for extremely punishing one-day drops. This is where volatility targeting, rebalancing, and dollar cost averaging can come into play. To take leverage equity risk and not think about it every day, leverage ETFs are a good fit. Whereas if you want to take risk across asset classes and trade as a professional would, futures are better. That's one reason I invest and trade both leverage ETFs, futures, and options. Leverage investing is fascinating and the returns can be breathtaking, but it isn't for everyone. If you can stomach the drawdowns, there's a lot of money currently being made with these products. Whether they'll continue to do so in the future is uncertain, like any other investment, but the history suggests it's more likely than not that they will. If you want to see in real time how I invest in my own strategies, so you can follow along and see my trades before I make them,